Hi, good afternoon, everybody. As Bethany mentioned, my name is Cynthia Zami. I'm the Director of Plan Giving for the West Coast for Jewish National Fund. Thank you for joining us. My colleagues are also here, Matt Bernstein, Robin Dermer, and Bill Adolph for today's solution-focused strategies for financial health and well-being. We are fortunate to have with us today Or Pikary, who will be discussing how to reduce your tax liability and make smart decisions regarding your financial and philanthropic goals with helpful year-end tax tips for 2020. Or is a proud JNFuture Board Member, and we're lucky to have him, and also a Senior Manager with the Los Angeles office of Mazars. Or provides tax and financial planning solutions to closely held businesses and their owners and families. His experience involves all aspects of business and individual tax advisor services, including development and implementation of tax planning strategies, entity structuring, succession planning, estate tax planning, and executive compensation and stock option planning. Please help me welcome Or Pikary. Or?
Thank you, Cynthia. I appreciate the warm welcome, and I appreciate everyone else choosing to spend their afternoon with us. So we've got a lot to cover, and I'm very excited about today's presentation. So let me start by sharing screen so we can get started. Alrighty, so tips to take you to 2021. It's a jam-packed presentation, a lot to cover, and I hope to get to as much of it as we can. So let's start by going through today's outline. Alrighty, so this presentation is divided into 4 sections. Oops, went a little too fast. It's divided into 4 sections. The first being what I call the usual suspects, where we'll discuss strategies that you want to give consideration to on an annual basis, no matter the year. And then from there, we'll go into charitable planning. And then we'll go into what I call a free step up in basis. And we'll end with a look ahead into 2021 and beyond. As far as the format of this presentation, I do want to make this interactive. I know a lot of Zoom presentations are structured so that all the questions come in at the end. What I would encourage you to do is submit your questions as we go along, and I'll make sure to stop in between sections of the presentation to take a few questions. Given we have a lot to cover, we'll do our best to answer all of your questions, but to the extent we did not get to your question, feel free to email me after the presentation. Alrighty, so section 1, the usual suspects. So to start with, I think we can kind of get to an agreement on what the core of any effective tax strategy is. And what I would say the core is that you want to minimize your tax liability on a long-term view. And the way you do that is you take advantage of every deduction, every credit that's available to you under the full extent of the law so that your taxable income is reduced. So one very simple, common way to do that is to make sure you take advantage of every last dollar you're allowed to contribute to your 401k or IRA account. So I don't want to go through every number, but effectively you're able to put in about $20,000 a year into your 401k. And if you're 50 and over, you get to put another $6,500 in a year. And then between yourself and your employer, you can put in up to $57,000 a year. If you're self-employed, then the contribution that applies to you is the $57,000. So what I would say is, we're in November, and this is a good time to to sit down, review what you've contributed to date, and to the extent you're able to afford to put in more, you probably should. Similarly, IRAs have contribution limits as well, and so do health savings accounts, which operate very similarly to an IRA, because you're able to make pre-tax contributions to these accounts and have tax-free growth of those contributions. One item I want to point out is there has been one change in the way IRAs operate. The Secure Act, which was passed in December of 2019, brought about a change where you no longer have an age cap to when you can contribute to a traditional IRA. Prior to the Secure Act passing, you could not make contributions to an IRA after you reached the age of 70 and a half. No such rules ever existed for a Roth IRA or regular 401k, but with this change, a traditional IRA is now on the same footing as a Roth IRA and regular 401k. So something to take into consideration given this change. Another tax strategy to reduce income is to take advantage of what's called a tax loss harvesting. And the way that works is you look through your portfolio, and to the extent you have investments that are in losses, it may be prudent for you to sell them, realize that loss, and you'll then be able to offset current year capital gains to the extent you have them, and to the extent you don't, you're able to carry those over and offset future year capital gains. I know you would then tell me, well, why would I want to sell an investment at a loss? Yes, I'm getting the tax deduction for it, but doesn't that mean I effectively made a bad investment move? And I would say not exactly, because what you can then do is you sell it at a loss. You can then go back in, buy the investment at around the same price you had it for, if you plan strategically, and you're able to effectively bouncing off the train, but coming right back in to make sure you see the growth as you initially intended. With that said, there is a wash sale rule, which you should be aware of. Most financial advisors are aware of this, and where if you sell a security or at a loss, you're only able to realize that loss and make sure you get a deduction for that loss if you do not purchase the same, or what's called a substantially identical security, which we won't get into that definition of today, within 30 days of that initial sale, whether it's before or after selling at a loss. I'll move on to the next slide here. Okay, so now the first few slides we were going on around items that are, you'll see tangible tax impact right away. But there are also items that you should be looking into that may not have a number, an initial dollar amount impact to them, but they're just as important. And so I put in about 4 questions here that you should be giving consideration to, and I would say at least on an annual basis. And with 2020 being a crazy year as it was, I would say that these questions are even more important than ever. So number 1, you should be asking, do you have the right beneficiaries named, whether on your wills, on your trusts, on financial accounts? And so to put this into a real life story, I can share. You'd be surprised about how many mishaps even our well-known celebrities have in this space around estate plans. So one example that comes to mind is the famous singer known as Barry White. When he passed away, he was still married to his second wife, but they lived separately for years. And he also had a girlfriend that was living with him, and they were in a serious relationship for many years. But unfortunately, because he did not revisit his estate plan, what happened upon his death is his wife, who was effectively divorced from him in his mind, maybe not on paper, she got everything. She inherited everything, but his girlfriend received nothing. It doesn't take much to guess that was not his intention. But unfortunately, that's the way things played out, because there was no active review of his estate plan.
Or I actually do have a question from somebody. So here's the question: with retirement assets, what controls the who inherits the retirement assets? Is it the beneficiary designation? What happens if there's a contrast between the beneficiary designation and the will or the trust? Which document is the controlling document? And this person's asking what they should do about that.
That's a great question. I think it's more of
my experience, it's the beneficiary designation that does control this. And so a lot of people create their will or their trust, which they think is the operating document that's going to control who inherits the retirement asset, but it's really the beneficiary designation on the retirement asset account. And for those of you who operate or conduct some of your finances online, those beneficiary designations, if you log into your account, can literally be found under the forms section of your account on most banking institutions. And so it is something to think about, to make sure just every 5 years or so that you have the correct person or entity listed on that account as the beneficiary, because that is the controlling document. If litigation occurs, that is the document that the court is going to look at. So anyway, sorry to interrupt. Go ahead.
No, that's great, because I wanted to say that's probably more an attorney determination. I haven't seen that play out yet.
Yeah.
So thanks for your perspective. We'll get back to the second bullet point, but other things to consider is, do you have the right fiduciaries named? I've had a client situation where they sat down with an estate attorney years and years ago, and the wife's sister was named as the trustee for their living trust. And then you roll forward years later, when we're sitting down to review their estate documents, and then from a simple reading of their trust document, I was just reading out the sister's name, and there was just an immediate hesitation and agitation of like, no way is my sister still the trustee. I don't know why it's there. I haven't been on speaking terms with my sister for 10, 15 years at that time. So those situations happen, whether it's a friend, whether it's a family member, whether the fiduciary is not even alive anymore, or not in a mental capacity to serve as a fiduciary. It's very important to revisit that. And then the next bullet point is, has there been a key life event? If there been a birth in the family, death, marriage, divorce, separation, as I gave the example of Barry White, all very important items to look at. And so with that said, I do want to go back to the second bullet point here, which is reviewing the beneficiary designation on your retirement plans. The Secure Act, which was passed, like I said before, in December of 2019, had significant impact, like probably the most groundbreaking changes to retirement plans in decades. And one of which is around the timing of when someone who inherits a retirement plan has to recognize income from those retirement plans. And so before we go into the change, why don't we just kind of go through a history, history of retirement accounts. And so the way retirement accounts work is you have what's called a required minimum distribution, or what's referred to as RMD. And what that is based on your age, and you have to take out a certain amount of a dollar amount year on an annual basis. And so the same thing would apply once the retirement plan owner passes away. Whoever inherits it is also subject to an RMD, required minimum distribution, based on their age. So for example, if the person inheriting a retirement plan is 18, their RMD would be a lot lower than someone inheriting at age 55 or 60. With the Secure Act passing, RMDs went off the table, were wiped up off the table, and instead a new rule was instituted where the person inheriting, with limited exception, the person inheriting a retirement account had to deplete the retirement account within 10 years. And if you think about it and give it some thought here, that's huge, because what that means is the average person, works 30, 40 years contributing to their retirement account, and by the time they retire, they have at least $1 million, if not millions, in that account. And to tell someone to recognize all of that within 10 years would translate into picking up income, significant income, at the highest tax rate. And that's in addition to whatever other sources of income they have, from whether it's their job, rental income, all of that other sources of income will also be subject to the highest tax rate. Never mind that maybe your inheritors are not even of sound mind and with sufficient financial literacy to manage all of that money coming in so fast. The tax bill is a shock in itself.
This has actually come up for me a few times recently, and it's surprising. I was talking to somebody who has an account, his retirement account's an IRA at Charles Schwab, and it's worth $2.6 million. He divorced 10 years ago and just never changed the beneficiary designation, but he went in to change the beneficiary designation, and they recommended he put down his 2 adult children as the beneficiaries, who are 48 and 50 years old. They both have full-time jobs, they're working, they have families. And so basically, if you live in California, which is where I live, it is possible, very possible, with federal and state income tax levels here, that $2.6 million is going to be wiped down within 10 years to $1.3 million. And when I was talking to the gentleman, I said to him, that is not a great idea, because you're sticking your kids into the highest tax bracket for probably 10 years and wiping out half of the savings that you've been saving for the past 45 years. And so it is something that you should really consider. We're going to talk about this a little bit more. I think Orr has some suggestions for us on what we should do about that. But there's some exceptions to the Secure Act that could probably work for a lot of people, and I just don't think people are aware of it. But it was a little horrifying to me that this man's financial planner recommended he designate adult children as the beneficiary without giving him further options. Go ahead, Owen.
Yeah, that is alarming, and not surprising, unfortunately, in the sense of I don't think that there's been enough press and education around the Secure Act as there should have been. So as far as strategies to manage this change, you know, I would say a few that I can that I turn to is number one, your spouse is exempt from that 10-year rule, meaning if the spouse inherits your traditional your IRA retirement account, they will not have to deplete within 10 years of inheriting. And so what I suggest is make your spouse your primary beneficiary, and then either have your kids as contingent beneficiaries, but even better, have a charitable remainder trust as a contingent beneficiary, which would then have its own set of beneficiaries. That trust would have its own set of beneficiaries.
I actually have a couple of questions people have asked. So one is, what if the beneficiary of the retirement account is a charity? What happens to the Secure Act, and does it affect the charity in any way?
I don't think that under the Secure Act, there hasn't really been any change that will impact the charity. So I think if you have a charity as a beneficiary under the Secure Act, that's a non-issue.
Because the charity is a non-taxable organization?
Exactly.
So you can't, so I do say to people, if you're thinking about leaving an asset to JNF, a close look at your retirement assets are the best basically bucket to look at, because a non-charitable beneficiary of a retirement asset will pay income tax one way or another, and now under the Secure Act quicker than a charity, because the charity just doesn't pay, you know, there is no income tax ramifications for the charity. I was going to also ask, what about you're kind of recreating the stretch if you create a charitable remainder trust as the beneficiary. So like in your prior example, what would happen if you had the spouse as the first income beneficiary of the charitable remainder trust, and then the children as the second income beneficiary? And actually, before I start, I don't know if you want to explain it, or maybe I should. What is a charitable remainder trust?
I can give my version of it. So charitable remainder trust was traditionally used as a way of donating usually appreciated securities or appreciated assets to a charity, but without losing the income benefit or the income stream while you or your beneficiary is alive. So for example, what you would do is let's say you have a piece of real estate that has appreciated significantly over the years. You would turn around and donate it to a charitable remainder trust. That charitable remainder trust will then distribute income under preset conditions to the beneficiaries, whether it's yourself or your kids or whoever. And at that time, you will also get a charitable deduction, because you're designating a charity that will eventually receive that asset at the end of the trust's term, whether it's when the beneficiaries pass away, or let's say it's a 20-year term, whatever it is. So you're getting a tax deduction. You're still getting the income from, in that case, the rental property. And I would also add, you would not have to recognize capital gain on the appreciation by doing this. So 3 benefits so far. And eventually that asset will find its way to a charitable organization. So that a great great strategy to use in and of its own. But with the Secure Act, the way you can use a charitable remainder trust differently is you say, well, I'll make that charitable remainder trust the beneficiary of my retirement account. The charitable remainder trust picks up all the income, and there's really no tax implications here. aside from your beneficiaries picking up taxable income to the extent they're taking distributions. So if the CRT or charitable remainder trust takes out all of your retirement account in the first year of inheriting, there's no tax bill there, but there's only a tax bill to the extent the beneficiary is actually taking income out.
So, or can I ask you, so basically to do this, it's the retirement account would not pass into the charitable remainder trust until after the donor passes away. Then the spouse will get the income for her life or his life. And then the adult children will get the income for their lives or 20 years, whichever's less. And then the charity gets the remainder at the end. Is that right?
That's correct. That's correct.
Somebody just asked, is there, if you leave the retirement asset to a charitable remainder trust, does that amount of the value of the asset of the retirement account get taken off the value of the estate for estate tax purposes? And can you talk about that a little bit?
Yeah, it does get removed from your estate at a discounted rate. You're not able to just, so let's say, in a simple example, let's say you have $5 million in your retirement account. That doesn't, you're only able to take out a percentage of it out of your estate, because what happens is another percentage goes to charity. So a percentage of the contribution becomes a charitable contribution, and a percentage of that value becomes a reduction in your estate.
Thank you.
So, yeah, I hope that answers it.
Does anybody have any other questions before we move on? I don't think so. Okay. Okay, so now we'll kind of tie this in. There is one more strategy that you can use in the realm of the Secure Act, but it is a good strategy in and of its own, and that's called a Roth IRA conversion. And so if you think about the way a Roth IRA works as opposed to a traditional IRA, is that a traditional IRA, you contribute funds pre-tax, and when you take distributions later, you pay the tax on those initial contributions at that time. A Roth IRA works in the opposite way, where you contribute now, post-tax, and then when you take distributions out later, it's tax-free. With that said, there are limitations. Not everybody can make contributions to a Roth IRA if their income is over a certain threshold. But of course, as everything in the tax world goes, there are always exceptions and there are always loopholes. So the way you can kind of go around that is you can convert some of your traditional IRA contributions at a later time to a Roth IRA. And that strategy, there are no taxable income limitations. Even high earners can do this. But to do that, you have to be willing to pay the tax on that conversion, because you're converting from pre-tax to post-tax. And so So what is it?
A couple
is it
of things.
The income tax that you have to pay on the conversion? So if you had $500,000 in a regular IRA, traditional, you try to convert that, you would pay income tax as if you were withdrawing the $500,000?
That's right. That's exactly it. And so the ideal time to do that is in a year where you may have less in taxable income than usual, whether it's because you were working part-time for some reason, or another scenario I could see is where you stopped working, you're in retirement, but you didn't take any distributions out for other reasons. And another example I can give is I had a scenario with a client. She was already retired. She worked she had a good chunk of rental losses that have been accrued over the years, and and the way losses work is that you can carry over losses for up to 20 years if they were incurred before 2018. Post 2018, the carryover is unlimited, but pre 2018, it was a 20-year carry forward for those losses. And so in her scenario, we were projecting out her income and over the next few years, and we couldn't see a place where she would have enough taxable income to actually use up all those losses as an offset. That's an excellent place to say, let me recognize some Roth IRA conversions and essentially for free, because you have lost offsets. So
we actually do have a question. Do you have to convert the whole IRA, or can you do a little each year? Or a percentage?
No, it does not have to be in whole. You can make partial conversions year to year.
And what's the effect on, so somebody who's inheriting a Roth IRA, the person who's the main, the contributor to the IRA, when they pass away, what's the tax effect for a Roth IRA on their, whoever inherits the IRA, their kids or their spouse?
Yeah, so that's the other benefit of a Roth, in that a Roth IRA will also have to be distributed out within 10 years under the Secure Act. It's not as painful to the inheritor because Roth distributions are not taxable. So you could effectively just leave it in the Roth, let it grow tax-free, and then just distribute it out at the end of the 10th year with no tax bill whatsoever.
So it's probably better to leave it in, right? For those 10 years, because you're leaving it in a tax-free environment where it can grow and not, there will be no taxes paid for that 10-year period. Is that what you're saying?
Exactly. So all that appreciation, all the dividend income, interest income is accumulated tax-free. So I would definitely keep it in the Roth for as long as you can.
Great.
Now, with that said, you can also use charitable planning to offset any tax bills you have from converting a Roth account or partial Roth account. Converting from a traditional IRA to a Roth account. And so what this is showing right here is if I let me just get the laser pointer. So if I convert $500,000 into a Roth account, my tax bill would be, in this example, $185,000. But if I make that same conversion and then also make a donation to charity in the same year, I'm able to lower the amount that goes to Uncle Sam. Not a bad strategy to keep in mind when making conversions to a Roth IRA.
That's great. So somebody just asked, should stretch IRAs be revisited if they're part of your estate plan? And I will tell you, that's what this Secure Act is doing. It's eliminating the stretch IRA for your beneficiaries after January of 2020. So currently, the stretch IRA doesn't exist anymore. There's ways to recreate the stretch with a charitable remainder trust, or you might want to consider doing the Roth conversion if you're able to. But it is something that is incredibly significant. I don't know, or you mentioned when we talked before, you were telling me how much the US government expects to gain from this law in the next 10 years.
Yeah, actually, I had it written down. They estimated by removing the stretch, they will raise an estimated $16 billion in additional tax revenue over the next 10 years alone.
16
billion to be.
So it really is, I would say, something important to revisit with either an advisor that you have, or if you want to call one of us, we're happy to go over it with you, because your children, your beneficiaries will be the ones paying the consequences on this. And there is something you can do about it right now if, you know, it is something to think about, but there's options. So I'm sorry, go ahead.
Yeah, but at its core, the stretch IRA is a thing of the past. It no longer exists. It was only in existence for anyone that passed away before December 31st, 2019. So it's gone. We're not going to see it for the foreseeable future. But there are things you can do, like you said, Cynthia. Okay, so another item to consider is under the current new regime, which came in to play in 2018 as a result of the TCJA, the Tax Cuts and Jobs Act, is the standard deductions. The standard deduction got raised significantly, and what that did is, I think the statistic is like it now brought it to a place where about 80% of the country is not itemizing, given how large the standard deduction is. Because if you think back the way it works, you can use an item, you can take an itemized deduction if it's larger than the standard deduction. And if the standard deduction is now so large, it's even harder to do so. But you always want to try to find a way to still do so. And I think there are still strategies you can. And so I'll give an example. And the strategy is called bunching, because you're effectively accelerating deductions into 1 year rather than over 2 or 3 years. Why don't we look at an example I have with an illustration?
Actually, before you go on, can you just explain,
Sure.
because I don't know if everybody really truly understands this. I sometimes have a hard time with this. Why
Sure.
is it better to itemize your deductions? Don't you just get the standard deduction and then you don't have to actually do anything? You just get it right off the top of your taxes. Is that right? Or your income. It reduces your income without you doing anything. Why is it better to itemize?
Well, because I think, you know, there's certain expenses or certain activities that we will still take part in, whether or not we take the itemized or standard deduction, and you're losing a benefit from participating in those activities, whether it's you know, paying your mortgage or philanthropic endeavors, such whether you're involved in JNF or another organization, and if you're able to itemize, your donations could actually cost you out of pocket less. So you know, a simple example before we go into that illustration is, let's say, you know, there are scenarios where you could be, you know, maybe you have plans to donate $10,000, actually $5,000 a year to your favorite charity, whether it's, let's call it the JNF in this case. If you say, well, I'm going to donate $5,000 a year to the JNF, and I would tell you that you want to make sure that you're aware of where things stand as it relates to your tax position and whether you're itemizing. Because, you know, a simple example, let's say you give away $5,000 in December of 2019, $5,000 in January of 2020, and you're not itemizing in either year because you're below the standard deduction when adding up all your other deductions, you're getting no tax benefit from that deduction. But if you were in such a place where if you had donated the full $10,000 by December 31st, rather than split it between December and January of the next year, that $10,000 donation could cost you $8,000 or $9,000 instead of $10,000, because you're now getting a tax benefit that you would have not received if you were taking the standard deduction.
So you could save $2,000 just by bunching your deductions in 1 year. You know, somebody actually just asked if you could talk a little bit about the SALT cap of $10,000 and what exactly that is.
Sure. So I think I can kind of answer that by tying this into this illustration. So the SALT deduction came into play as part of the TCJA, the Tax Cuts and Jobs Act,
And
where
what is SALT?
you can
I'm
only,
sorry. What does SALT stand for? Somebody wrote that, but I should.
Yeah, SALT is the state and local taxes, and so before the last set of tax reform, you could deduct essentially unlimited amount of state and local taxes, whether it's property tax, income tax, or even the tax you pay to DMV every year. All of that falls into the same bucket. As a result of the latest tax reform, they kind of said, well, we're lowering the tax rate, and to kind of offset that partially, we're going to limit the amount that you deduct for state and local taxes, or SALT, to just $10,000 a year. And that includes, again, property tax and state income tax. And so what that I would say, just one note on that, is that changed the way a lot of people spend or pay up their property taxes. In most counties, property taxes get distributed out. You get two vouchers, one due in December and one due in February or March of the following year. It used to be that people would say, oh, I'm going to accelerate it. I'm going to pay it all in 1 year, get the benefit right away. But with that limit, what that did is a lot of people are kind of saying, well, I'm just going to pay one voucher because I'm already over 10,000. I'm not going to get a benefit. And that's something you should be considering if you're not already. And I'll just emphasize, I don't want to spend too much time on this, but I'll emphasize that deduction only applies to any property or income taxes paid on the individual level for a primary residence. But if you have a rental property, that limitation does not exist. If you have a vacation home and you're renting it for at least a part of the year, then it will exist only partially. And if it's property tax paid by your business, that limitation does not exist either. Hope that answers that. There's a lot of other strategies around that, but yeah, I want to make sure we cover all the other stuff that we have in this presentation. So quick, just going through this quick illustration here. So the standard deduction for 2020 for married filing jointly is $24,400. And so what this is showing is this couple is paying $10,000 every year, or projected to pay $10,000 every year in state and local taxes, $5,000 every year in mortgage interest. Yep. And $10,000 a year in charitable donations. And so a total of $25,000 in deductions every year. But if you notice what's happening is because the standard deduction is $24,000, meaning that's a deduction you'll receive regardless of what these amounts are, then your only extra benefit is $210 a year, or $630 a year in tax savings, because you're only able to get additional savings on the $600, meaning the extent of $25,000 exceeds the $24,400. But if they bunch it where they're paying in their state local tax, well, you can't really control that. It's the limit. So you take that deduction. Mortgage, you can't really control that because that's your interest. You're paying that in $5,000. But then you're saying, well, you know what? I'm going to accelerate and pay $30,000 in year one to my favorite charity and not paying anything else in the following 2 years. Your tax savings became $7,210 here, which is $6,500 more than if you had paid it over 3 years.
Somebody just asked, can you explain how you could use a donor advised fund with this bunching strategy?
Yeah, for sure. So the way a donor advised fund works is you are able to donate stocks or other assets or even cash to a fund you get a deduction in that year, and even though that contribution did not make its way to a charity yet, and then from there on, all the income that's earned within that donor advised fund grows tax-free, and you're able to make distributions or donations to your charity as you wish over the next how many years you would like. So you're getting a deduction now.
I will give a teeny tiny pitch, because JNF has, a lot of the banking institutions have donor advised funds, but JNF actually has also a donor advised fund. We probably have the lowest fees in the country. But the other thing that, Or mentioned, you can donate cash, stock, mutual funds, etc. We actually have taken many different types of assets, real estate, LLC interests. So if you have something of value, you need a deduction this year, but you're not really sure what to do with the money that you donate, you can put it into a JNF donor advised fund and not only donate to Jewish National Fund, but to all of your favorite charities, as long as it's a qualified charity in the United States. Nate asked that question. Thank you, Nate, because that was a great segue. But anyway, go ahead, Or.
All right, so I think we have like about 10 minutes left. Is that correct?
Yes.
Cynthia, is there something you think we should try to cover more than other slides?
I think we probably, so we're going to share these slides with everyone afterwards, and please feel free to contact one of us or but I think we probably should skip to the what we're expecting in the future, because I think that's a huge concern of what people have.
Okay, fair enough. So yeah, looking ahead. So if you haven't been paying attention, we had an election this year. And there's going to be a change in administration. And so what I'm showing on the screen here is a list of proposals from former Vice President Biden. Now, these are all proposals. We are, as we've seen in past administrations, proposals are one thing, getting them through Congress is another. Usually only a small percentage of proposals pass through, if you're lucky. But the overall theme here that you're seeing here is that taxes are going to be on the rise. And I think if we think about the state of our country, with our budget deficit increasing every year, our national debt increasing every year, and this last year, government spending on the state and local, federal level has been astronomical. It's almost a given the tax will go up no matter what administration will come in. And so as we think about that, I would say that there are a few strategies, really two, at a high level that we should be trying to implement, and that is accelerate as much income as you can into 2020. If you're with me and you see a picture similarly where taxes will have to go up eventually, given where we are as a country, I would say accelerate it to the extent you can. Make those Roth conversions, harvest gains, maybe defer some loss harvesting, defer some business expenses, and take advantage of these lower rates. They may seem high today, but in the long run, I think they'll actually look low. But at the same time, it may sound like I'm contradicting myself. I would also say try to accelerate deductions into 2020. And the reason I say that is there's something on the table here that actually was on the table when President Obama was president, and that was to limit the benefits of itemized deductions at just 28% of the value for people earning over a certain amount. And what that means is effectively, if you're earning, in this case, if you're earning over 400,000, this is this bullet point, you can only get a benefit of 28%, meaning for every dollar you deduct, you can only get 28% cash back on your tax return, where right now and historically, you get a cash benefit of whatever your tax bracket is, which the highest tax bracket today is at 37%. Before, about 4 years ago, it was at 39.6%. So your benefit from deducting may actually be decreasing if such proposals go through. Yeah, so that's a high level. We can talk about this all day, but that's a high level.
Somebody did
message.
just ask a question, which doesn't have so much to do with this tax plan proposal, but just about donating stock. Is it 100% of the stock? If you donate stock, what's the deduction amount that you get? And is there a capital gains tax implication, if at all?
Yeah, that's a great question. It was actually one of my slides where I think the most common form of donation is cash, but I would argue that's the least tax efficient. And the reason is that if you have appreciated assets, whether it's stock or other, you're able to get a deduction for the fair market value of that stock or real estate at the day you donate, and you are able to and you don't have to recognize any capital gain on the appreciation. So that's a double benefit right there. I would encourage you to make stock donations, appreciated stock donation, over cash any day.
So what if you have, for instance, Apple stock, and you really, really, really love your Apple stock, but you want to make a gift? What's your suggestion?
I would say make that Apple stock donation, and then go buy Apple stock the next day. There's no tax rule that prevents you from doing that. And that actually brings me to this example here, where if you're debating donating $20,000 in cash or $20,000 in value of stock, the way, if you go through this and you go through the tax implications, your tax savings is about $15,000 by making that $20,000 contribution. But if you made a stock contribution, it's $18,000, because not only you get a deduction for $20,000, but in our example, you're also avoiding capital gain on appreciation of $30,000. And so this is one example. I'm sure there are even better ones if you've had stock investments for a while.
Okay. Well, I think we're almost out of time. Or I want to say thank you so much for spending this hour with us and giving us some advice. We're going to be sending out a thank you email that has the PowerPoint so you can read it, because we did have to skip over some of it, and or had written an article about some tax issues that we'll be sharing with you. If you have any questions, and I do see there are some questions, we'll get in touch with you about the leftover questions. But if you have questions you didn't post, please feel free to contact us or contact OR, and we really appreciate your time spent with us and your dedication to Jewish National Fund and the land of people of Israel. So thank you so much and have a great day.